thank you so much to Jamie for being here. So we are at your high yield and leveraged finance conference in Miami. You've got executives, deal makers, investors all kind of coming together to talk about the financing environment. How would you characterize C-suite confidence levels now?
First of all, thrilled to be here. Thank you for doing this. This is our 29th conference. I've probably been to 20 of them since I became CEO of JP Morgan Chase. You know, look, you always got to look at markets that they change their mind pretty quickly. But right now, confidence is up. There's more M&A chatter. Equity markets open a little bit. Spreads are getting close to historical lows, which means there's a lot of money chasing high yield deals. So things are kind of open. Markets are high. People feel it. So far, so good.
That sounds to run somewhat counter to your more bearish views. I know you said in fourth quarter earnings that last month that inflation may be stickier, rates may be higher than the markets expect. Is that still your base case? And what's kind of fueling that more cautious tone right now?
Yeah, so the way I look, remember in 1972 you felt great too, and before any crash you felt great, and then so things change. So you got to look ahead. And I do think there are things out there which are kind of concerning. We've got an eye on, and why are we doing so well? A lot of it's fiscal spending, and fiscal spending has a multiplier too. So I just think it may not come down that quick, and people may be surprised. So when people talk about, the market is kind of pricing a soft landing, that may very well happen, but the odds at 70 or 80%, I would give them half of that, that's all.
7 or 8 rate cuts?
No, 70 or 80% chance we'll have a soft landing. I give it half that. We may very well have one, but I think there was also a higher chance in the market thinks of rates being a little bit higher. The other thing I think it's always a mistake to do is look at just the year. All these factors we talk about, QT, fiscal spending, deficits, the geopolitics, those things may play out over multiple years. But they will play out and they will have an effect, and we just don't know what they are. So I'm just, in my mind, I'm kind of cautious about everything.
You're hedging.
Yeah.
I want to ask you about commercial real estate. We've got nearly $1 trillion of commercial multifamily real estate debt that will mature this year. About half of that, about $1 trillion, $929 billion worth.
Yeah.
Half of that is owned by banks, mostly regional banks there. The rest is either securitized or due to non-bank lenders. We've seen higher levels of defaults in certain pockets of the market and a slump in property prices recently. Do you think that stress in commercial real estate will ultimately be the source of the next credit event?
First of all, put commercial in perspective with consumer. The consumer markets are far bigger. So what happened in 07 or 08, this isn't that kind of thing. And a lot of these owners of this can handle what you call stress. So in the banking system, I'm just going to focus this in office for a second, because there's warehouse, there's data centers, there's hospitals, and some of that stuff is actually well done. But if you take just offices, first of all, they're worth less because of interest rates. When interest rates go up 300 basis points, whatever you own with their cash flow is worth 30% less. And so people, that's not a crisis, that's kind of a known thing. And then there's if you have a recession, yes, it'll get worse. If we don't have a recession, I think most people will be able to muddle through this, refinance, put more equity in. And of course, when you talk about defaults being higher, part of that's just a normalization process. They were so low for so long, so in all of credit, you're watching things go up, but they're not at a crisis level, they're just kind of going to normal. So yes, if rates go up and we have a recession, there will be real estate problems. And some banks will have a much bigger real estate problem than others.
So you think, as you kind of assess the landscape and regional banks, there'll be more of a whack-a-mole than a kind of domino effect?
As long as the economy stays like this, there'll be more of a whack-a-mole. There should be no domino effect. The problems you've seen were kind of idiosyncratic problems with Silicon Valley, First Republic, New York Community Bank, and a lot of these, it's very local. I mean, you talk about real estate, I think when you say blanketed, if I call it an office and I have great leases in it, it's fully leased out, 20-year leases, that's completely different than a spec building. So you really got to dig deeper, and we try to do that when we look at credit about where it is. It'll be pockets.
Are you concerned at all about just the migration of lending taking place in the non-bank financial sector? I mean, we're here at the Global High Yield and Leveraged Finance Conference. I know there are a lot of private credit managers here, but that's something that's caught the regulators' attention as well.
Well, finally, maybe wake them up a little bit. First of all, I don't mind competition. Some of these people who you call private credit are excellent. They know what they're doing. That doesn't mean they all do. And when you look at policy issues about private credit, first of all, we've been doing it a long time. Just keep in mind, like, we make loans, middle market loans. They came through with a bunch of stuff that made it simpler. Unitranche, actually more expensive. Unitranche, different covenants. You could sign it quickly, no pricing. But there are other things: less transparency, less liquidity, no secondary markets, no research. So you got to look at the whole thing, what works and what doesn't work. It will sort through it. We'll be a competitor. I have no problem knowing that we're going to be a competitor. And a lot of smart people out there, they've been on TV saying, I said they're dancing in the street, but they agree with me this time. They say absolutely, banks are being pushed out of a whole bunch of different businesses, and I always say if that's what the regulators want, then do it. I'm completely fine with it. JP will do fine, but it should be done with the forethought, not accidentally. Like I said, there are some negatives. So I think if you have a major recession, you'll probably see some issues in private credit. Whether systemic, not, I don't really think so, but it might be in ways we don't understand today.
Speaking of competition and regulation, last week we saw a major deal with Capital One and its deal to acquire Discover. The potential there is to reshape the credit card industry. The combination would create the largest card issuer in the U.S., surpassing JP Chase.
For now.
As measured for now. So if this deal is approved, does it create more competition for you?
I think companies should be allowed to do and innovate and grow and merge and try to challenge things. I think that's good. So I think it's a mistake to act like it's bad. It's good for competition. In fact, I think they should allow some of these smaller banks to merge. If that's how they think they can best compete with JP Morgan, you should let them. It may not work in every case, but you shouldn't predetermine that. You should let the market predetermine that. In this particular thing, there's the credit card business, which is they'll be bigger, more scale. They're very good at it. I mean, I have enormous respect for Richard Fairbanks and Cap One. And then there's the networks. There's the debit network and the credit network. The debit network, it may have an unfair advantage versus us. Of course I have a problem with that. Why should they be allowed to price debit different than we price debit just because of a law that was passed? I don't know what their plans are really. Like I said, I have whatever Richard does, I pay a lot of attention to do. Can they actually create another credit card network? I don't know. But my view is let them compete. Let them try. And if we think it's unfair, we'll complain about that. But I'm not worried about it really. But we do track everything he does.
So JP Morgan CEO Jamie Dimon said right now confidence is up in the markets, which is really good. And he said spreads are near historical lows, which means money's being put to work, guys. He said there are some concerning things ahead. There's QT, there's physical spending and geopolitics, but he said that should be dealt with over the next several years. He gives a soft landing a 35 to 40% chance. He says rates were so low for so long, but we're not at crisis levels now. It's just going to take a little bit to get used to it because they were so low for so long. He says if we have a recession, it will hit real estate hard. If not, people will refinance and make it through it, even though they might have a little bit of damage. JP Morgan welcomes competition. He says it's healthy and that's how it should be. He doesn't know why banks aren't allowed to merge together and compete and do all this. He welcomes the competition. He says the economy is so far so good, but is hedging his positions at these levels. There's nearly $1 trillion of commercial multifamily real estate debt to mature coming up. So it's just another thing we've got coming up in the economy, guys. Hope you enjoyed the video. Hope you learned something. Catch you in the next one.